All right, another weekly update on the rental house versus high income ETFs. It says income ETFs because there wasn't room to put high income ETFs on this thumbnail. So this is season 2, episode 5. We started this November 2024. We sold most of our rental properties. One of the last rental properties we sold, we took the proceeds, put it into a Robinhood account, into mostly covered call ETFs, and using some margin. Thinking was that that would do a whole lot better than if we would have kept that rental house, collecting rent. The house was paid off, and you'll see the numbers here in a little bit. And my theory has been pretty spot on. It is doing better. I was a little bit nervous back in April when the market kind of tanked a little bit. I was missing that house for a little bit, but only for a few weeks. Then I got my senses back, and then I realized, no, this is better. So what you're about to see is not financial advice. In fact, some people think it's bad advice, and I know that because they leave comments saying this is bad advice. I appreciate those comments. If you're going to take the time to leave me comments about bad advice, at least subscribe, like the video, turn on notifications so you can see more bad advice in the future. I'm actually kidding. I think this is good advice, but I don't give any advice, just entertainment. So I like to pop this up every week to see how the market is doing in general. So the market, you would think, dived a lot more than what it did, just took a little dip here, but it felt like it took a big dip. So this is a screenshot from the Yahoo charts. I basically just use these indicators here to keep track of things. Bollinger Band, 50-day moving averages, and the RSI. Black line's a 20-day moving average. Red is 50-day moving average, and this is the RSI down here. I won't go into the details how I use this. I have other videos that explain that. What you're here to see is how much money did I lose this week. Well, there's a lot of red on here, and if you look at my thumbnail, there's more red this week than on this thumbnail, and this is what I'm talking about. So the market was down like 1.69% or so. Everything is kind of red. The only thing that's green is a cash secured put that I rolled forward, and we'll talk about that in a little bit. But even though things are red, they're not red in a big way, just a little bit red. And over here you can see what tickers of ETFs I'm using. I won't name them all off. You can see them over here. I just will say that my favorites are QQQI and TDAC and SPY-I. Those are my favorites. And all those tickers pay either weekly or monthly distributions, and these are my most recent distributions going back to January 23rd. We got one from SPY-I, and we got one from QDTE. So QDTE is interesting. The distributions have been declining, but the overall return has been pretty good for the past month or so. I'm kind of wondering if they're holding back some of the distributions to help the NAV, the net asset value of the ETF, to try to boost that up a little bit. Now, there are some tax laws that saying they can't hold on to too much of that money, especially at the end of the year. I don't know all the legal details and tax laws, but I'm just kind of wondering if that's what they're doing a little bit. And then we have MAGY, which paid out a decent distribution, and I'll be getting another one of those on Monday, and then AIPI, and then here's this other QDTE. So QDTE pays weekly, and so does MAGY, and the rest of those pay once a month. So I generate some income in this fund two ways, and the second way is selling options, so mostly cash secured puts. So you see back here in December, these are the trades I closed in December. I ended up making, I don't have the math in front of me, like maybe about $400 or $500 for the month of December selling cash secured puts. And for January, I was doing pretty good until SoFi, the earnings came out, and the earnings were excellent, but the price dropped like 10% on SoFi. So Friday, the expiration date was 1/30. That's Friday. And so I had to do something with this. I could either let it expire, and then I would have bought 400 shares of SoFi at $24 a share. Now, that wouldn't have been horrible at all, but I'm trying to avoid getting assigned shares in this account. So the other option is to roll that forward. Basically, I'm closing this trade here, and then I open a new trade a week later for 2/6. So by doing that, it's one transaction. I close this trade, And on this part of the trade, I lost $284. And then on this part of the trade, I made 4 times $1.60, which would be $640 if I'm doing my math right. So you take this 160 times 100. So since I made 640 here, I don't enter the profit until I close the trades. But let's say this ends up at 640. I would subtract that 284 from that, and that would be my profits. $380 to $400 probably. That's if the price of SoFi bounces back up above 24. If it doesn't, then I will just roll that forward another week and keep doing this every week until it gets back in the green, and then everything will be fine and dandy. The other concern up here, I got one that's going to expire February 20th, and the price is 26. SoFi is trading at 23 right now. So if the price of SoFi is at 23 on February 20th, I'll buy 400 shares of stock or roll that one forward. But the problem here, I'll be paying $26 a share for it instead of the 23 or whatever it's trading for at that point. So what I'm saying is I want the price of SoFi to go up above 24 by next Friday, and I want to go above 26 before February 20th. And if that happens, I'll be happy. And I got these other TQQQ and the AMZU cash secured puts here. So I didn't mean to go down that rabbit hole, but overall I made $234 for the month to help boost a little bit of income. And this here shows what I made for income for the month on this account, also showing the interest I paid. So the option income I just bring over and put right here. And these are all the distributions from the ETFs. So ended up at 41.72.97. And that includes subtracting the margin that I'm using for that account. And this here shows the ETFs I'm buying each month. Now, I haven't been buying too much so far this year. I bought 200 shares of TDAC when the price dipped down here a week or two ago, I guess 11 days ago. So my goal was to not buy any more shares until my margin gets paid down to be 50% of what my total equity is. And I'll talk about that more in a second here. And we'll pop this up. So I like to pop this up and compare what each individual investment in my account is doing. Now, SPY and QQQ are here just to compare what I have to this. You see the total return for AIPI is down 3%. So this is AI stocks ETF, and it pays a distribution of about 35% per year, but the NAV has been declining a little bit, so I got to keep an eye on these. But let's look at the SPY, 1.27%. It's actually doing better so far this year than QQQ. So the tech stocks and AI stocks are kind of slow at taking off this year. So here's QDTE. I told you the distributions had dropped down so far, but overall, it's actually doing better than the indexes here, SPY and QQQ. And my SPY is based on the SPY, so it's second kind of close. And QQQI is just a little bit less than QQQ. MAGY was in the red a week ago. It's back in the green, but barely. And then TDAC is in the green, but not as much as I would like it to be. And for 2020, experiment earned 36%. And for 2026, I forgot to update that. And here on the next slide, it's actually 2.8%. So what this chart here shows what I projected. And then over here is what's actually happening. So over here, you can see the margin balance here. My original goal was keep this about 75% of the amount of money I got in the account. So I started out at 70,000, like back in November 2024. And then I started out about 50,000 margin, which was about 75% of that. And then as this grew, I kept this at about 75% of this amount over here. And this over here shows the percent of margin I'm using. So my goal for 2026 is to get the margin down to 50%. So right down here where this is green shows where my margin will be 50%. So at this point, projected my equity will be 108,000, and then I'll be using 54,000 in margin. The total invested will be almost 164,000. So that'd be the money that I'm earning dividends and distributions from the ETFs on right here. So the reason why I'm doing that, even though a year ago I ended up like a 36% for the year, I'm actually trying to get the 50% return for the year. And what I'm doing is trying to use the option income to boost this up a little bit. Now, you can sell options and use margin to do that, but you don't have to pay interest on the margin as long as you don't get assigned the shares. I don't mean to get complicated here, but I have several other videos that show how you trade options and sell options and all that good stuff. So I'm pretty conservative in my opinion. That's my opinion. Some people say I'm too aggressive, but on this account, selling options and trying to avoid to get assigned the shares because I don't want to pay interest on owning any shares. If it does happen, it's okay. Then I'll sell cover calls on the other direction and do that until those shares get sold and then go back to selling cash secured puts. But this video is not about options. It's about making money in this account. So anyhow, going up here, I started this fresh for 2026 and on the 30th here where it's yellow, this is this week. So we're sitting at about 96,855. I project it would be at 98,000. And actually early in the week, like Wednesday, this was over 100,000 for a few days. So we're close to that. And then the margin I expected to be at 62,000, but I'm at 64,000. The reason why that's up is because I bought a couple hundred shares of TDAC when the market had dipped. My margin jumped back up to 66,000 here. And then the last couple of weeks we had several distributions from those ETFs. So that paid that down about $1,500. So I suspect that around the middle or the end of March, I should be caught back up with my projected margin. And I still suspect that I will reach these numbers here by May 1st. If I didn't think that would happen, I wouldn't have bought those shares of TDAC when I did. So when we get to May, instead of letting this margin get paid down perhaps all the way to zero, my plan as of right now is start buying more ETFs again and build those up. And I'll probably be buying QQQI, TDAC, and SPY-I, adding to those three. And if I jump back here, I probably won't add any more to AIPI, MAGY, or QDTE going forward, not for the time being. I'm happier with SPY-I, QQQI, and TDAC at this point. However, there's always a chance I might add another ETF in there if I find one that I like. So getting back to this slide, we're up 2.8% for the year. Last week we were down 1.9%, and I'm using 67% margin. So this number here is 67% of this number here. Like I said, I'm trying to get that down to 50%. And that'll happen just based on time. And if I bounce back here, you see that I'm collecting about $4,000 a month. Actually, this would be closer to $3,500 a month going forward because this is an unusual big distribution here. You could probably subtract almost 1,000 off that. So this number should probably be like 3,200 instead going forward. If you did a little math, if you figure about $3,500 per month times 3, that'd be $10,000. That'll put me right about 54,000 in 3 months if I don't buy any more shares of stock. So this is about comparing how things would have went if I would have kept that house compared to this. This is kind of the estimate of how this house would be doing if we would have kept it. And for the first year, I raised the rent to $800 per 10. I don't have this house anymore. And so this $450 a month here are the expenses, includes taxes and insurance. Taxes are very expensive in Illinois. Insurance is very expensive as of late, includes the normal repairs, so on. And I also figured that the house would grow at 4% per year, which comes out to be $233 per month about. So this would be the cash balance. Let's say in my checking account, this would be what the equity has grown to be. And so this would be about the total house equity plus the cash, about $78,570. And this quickly is for my taxes, shows the expenses for 3 years from 2021 to 2023. I didn't really include 2024 because we were selling the house in 24 and it was empty for several months. So it's hard to get an average, typical monthly range, but the expenses were about $368. And before we sold the house, we spent a whole bunch of money repairing things and fixing it up. And we ended up spending about $15,000 on it. Contractors are expensive, so it is what it is. But if I would have took that and divided it over, let's say 3 years, that comes out to be $309 a month. So if you add this 309 to the 368, you're at almost $700 a month, and I was only collecting $700 a month in rent. And actually, if you look at the rents received here over 3 years, I was averaging $609 a month. So really, in 3 years, I was losing money on this house. So how did things compare? Well, the house would be worth about 78,570, and my ETFs are sitting at 96,855 as of today. So my ETFs are up $18,000 over 15 months. So easily over $1,000 a month ahead in the ETFs. So the bottom line is that we're happy what we did. We're happy we sold these properties. So this is one property of several that we sold, and the money from those other properties, we're doing the same types of things, similar things. Either got them invested in high income ETFs, or we have it in an account where I'm trading options on. Those are doing wonderful compared to what the rental houses and apartment building was doing. However, that's, working for us. It's not financial advice, not tax advice, not legal advice, not any type of advice. But if you like this type of thing, make sure you subscribe, and we'll see you in the next video.